Well, we've been talking about President Trump's new trade deal, and of course today it gave the market a big boost on top of the ISM manufacturing number out today. The index came in slightly lower than expected, but overall we're seeing a massive expansion of the manufacturing sectors in other areas. Joining us now to discuss, Erin Gibbs, and S&P Investment Advisory Services Portfolio Manager, Michelle McKinnon, Payne Capital Management Senior Wealth Advisor. All right, ladies, let me first start with this, the impact of this trade deal. Pretty good initial reaction. Longer term, what does it mean?
So I see it good for three industries in particular. One, I think it's good for pharma, having those extra 2 years before they can compete on generics. I think it's good for transports in that it helps equalize costs and puts more burden on Mexican transports. And for the last one, just the autos, because we do export so little, I think that's beneficial for some of the autos. The bigger picture, though, all of these industries are pretty small. I mean, they're not a huge part of the S&P 500. We're talking about very specialized industries. So is that really going to make a gigantic impact on overall earnings and revenues across the board? No.
Right.
For these industries, yeah, this is good news for those three industries.
Michelle?
Yeah, I think it's great news. And I think the markets really have been held back here because of the trade discussions and because of the uncertainty. So now that NAFTA is done, I mean, who knows, we might get a deal with India. And I mean, maybe we'll see a deal with China, and that will just allow the markets to move forward. And what I like about that, too, is I think that's going to give an extra boost to confidence, which should push markets even further here.
So this is helping confidence. Confidence won't help that. Or so that's the chicken and egg kind of thing.
Pretty much. And then definitely, like, for the confidence, at least it's not hanging over you. Again, is it really going to make a huge impact on final numbers? No.
You know what I keep saying is, like, what people don't realize is our confidence numbers or the sentiment numbers are still below the all-time high. So the markets are up 150%. That's just the Dow. NASDAQ even more since those peak. I mean, so there's really a tremendous amount of room, a tremendous amount of space for Americans to become even more optimistic than I think we forgot we could be.
Yes, my only concern is that we're already trading at pretty high valuation levels. We're getting close to that top of that 3-year range, around 17.5.
But that's not where markets peak, though, right? Don't they peak in the 22, 23?
Yeah,
Isn't
that's
that
what we in 2000.
This year we peaked at 18. So not that far away compared to what we just went through in January.
Michelle?
Yeah, I mean, we got up to 18.8 or almost 19. We're down to 18, so I would say we're definitely not extremely expensive, and markets could definitely go forward here. What I like about it is, you have these continuing corporate earnings, which look strong, and I think you're going to continue to see them to look strong. And with prices being high, but corporate earnings being even better, that's amazing news.
Let's talk about potential red flags, because it feels like, something is always wobbly. Like today, NASDAQ was down, the Russell was down. A report out today that you've got 83% of the companies that have gone public this year losing money. I mean, anyone that lost money in the dot-com boom is saying red flag, red flag, red flag. Is it a red flag?
It's definitely higher than normal. And look, one of the reasons that as for our portfolios, we don't like doing a lot of IPOs is because most IPOs, the vast majority, are losing money 1 year later. But 83% is definitely higher than the average. It is an extreme value. And so that's concerning that, public markets aren't the place where people want to go to as much.
Michelle, well, should we be concerned about that, or is that just an intriguing sidebar?
I think it's an intriguing sidebar. Tech in general, because I know you're talking a lot about tech IPOs, are trading at about 19, 20 times earning. That's not excessive.
That's the ones who are earning.
Right. Those are the ones that are earning. So the general tech space seems to be not extremely overvalued. I think IPOs are a side space. But if you're worried about IPOs, then don't touch them, because there's a lot of other parts of the market.
So real quick then, because I want to wrap this up and ask you guys, if we get a strong jobs report, let's just say north of 200,000, do we break out? And if we break out, I know that a whole lot of money managers are flat-footed. They have not been playing this market. They've been afraid of a lot of things, including tariffs. They have to catch up. Can we break out this week? A real major breakout for a year-end rally?
I don't know. We're already trading kind of rich. Yeah, it might be a slight breakup, but
You're a little nervous. I haven't seen you this nervous all year.
I'm not expecting something amazing. No. We're especially when you start looking at 2019. Look, we get into earnings season. I think it's going to be a great Q3. But when people really start looking at 2019 and some of these impacts, you might start.
Comparisons are going to be tough, Michelle.
You know, I don't know if it's going to be next week, but the big thing that I see is there's $15 trillion of cash on the sidelines that has to move.
And that's just Erin's money.
Yeah, has to get its way back into the market. And so you're going to have a melt up eventually. Is it going to be next week? I'm not sure, but it's definitely coming.
All right, ladies, thank you both very, very much.